Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending August 4th, 2023. I'm Preston Brent. Thanks for tuning in. Well, everybody wants to know, is this a buy the dip moment? And if so, when is the dip going to end and when would we start buying? Well, let's just take a look at where the markets went this past week, and then I'll show you the charts and just kind of give you an idea of how we're thinking it here in our user group. If we look at the week, let me just get this up on the screen for you guys. You can see that U.S. indexes pretty much started August with a down week, right? Closing out a strong July. Stocks declined this past week. We did see Treasury yields moving up. We did get that unexpected downgrade in the U.S. government credit rating by Fitch. They moved us from AAA to AA plus. Now, remember the last time that happened was the S&P did this in 2011. So we're going to kind of see how this thing's going. But if you look at it, through the first 7 months of this year, we've had the best first 7 months of the year for the S&P since 1997. So I think it's going to be kind of a hard pill to swallow for a lot of big money firms to come in and pick up equities right now. I think everybody's going to, looking for a dip. I've been calling for it here for a couple of months. And I do believe the month of August and September is going to give us that pullback. I'll show you the charts in a minute where I've got tracked where I think the dip could start to find some consolidation and move higher. Okay. But if you look at the indexes here, you can see everybody's solidly in the red. Year to date, everybody's, pretty good in the green. Best performer for the week was energy. They're almost 3.5%. Worse, utilities. For the year, utilities bringing up the rear. Communication services is doing the best. So, and if we look at the PE ratio, I still think it's a lot higher than it should be at 20.75. That's the forward PE. And then, of course, if we look at the VIX, you can see that it finished the week at 17.10. So we had a little bit of a pop in the VIX. It moved up about 28.28% for the week, and it all started with that downgrade by Fitch. And then Friday, it looked like the markets were going to kind of move higher as we were going through the day. And then in the afternoon, markets really just started to pull back when we got the rise in Treasury yields. Also for the week, we did see the non-farm payrolls on Friday coming at 187,000 jobs in July. And really kind of a Goldilocks kind of report. Unemployment rate ticked down to 3.5% from 3.6. We did see wages grow about 4.4% over a 12-month period. So it's kind of unchanged from the prior month. So nothing really shocking there. But again, 10-year Treasury yield moved back up over 4%. I think an intraday on Friday was at 4.2. It settled in at a little over 4.5, 4.05. But that's still, anything over 4% can start to put some downward pressure on the equity market, and we're starting to see that right now. Okay. And if we go over to Europe and just kind of take a look at what's going on there, you can see everybody was in the red in Europe as well. The Bank of England, they raised their key rates another 25 basis points. So they're at a 15-year high of 5.25. And they basically said that the rates are going to stay higher for longer, much like what the Feds are saying here in the U.S. And their central bank there in the UK predicted inflation may fall to 4.9 by the end of this year. But that's still faster than what their forecast was previously. So inflation stands very sticky over in Great Britain. Meanwhile, their economic growth projections are still very muted, about 50 basis points for the year for GDP. And if we skip over to the European Union or the Eurozone, you can see annual inflation is still coming in a little bit. Like here in the U.S., it came in at 5.3% in July. That's down from 5.5% in June, but still well higher than their ECB's 2% target rate, much like the Fed's here. And the economy in the Eurozone expanded about 30 basis points in Q2. Keep in mind, Q2 here in the U.S., it came in this past week. We're getting it around 2.4%, right? Our headline CPI in June was 3%. Core CPI in June was 4.1. Now, core is what the Feds follow here in the U.S. So it's still over double. But the markets are taking a bet on whether the Feds hike their rates or stand down at the next Fed meeting here in the U.S., and that is set for about the third week in September. We don't have a meeting in August. So I believe most of the markets are projecting no more rate hikes through the end of the year. In fact, probably a rate drop in Q4, but maybe by Q1 of next year. Well, we'll see how that plays itself out. But swinging back over to Europe, you can see Europe was pretty much in the red across the board. Euro stocks, FTSE, CAC 40, DAX, all down year to date. Very healthy in the green, with the exception of Great Britain, the FTSE. It's barely hanging in there at 1.51% for the year. And then, of course, if we go over the Asian markets, you can see global investor risk is coming down, as evidenced by imports, exports, and not only China, but also Japan, right? The downgrade in the U.S. sovereign credit rating, kind of hurt a lot of markets globally. We did see Japan fall for the week, but it's still solidly in the green, as you can see, at 23.29% for the year. For the week, it was down about 1.79%. The yield on the Japanese government bonds rose to about 65 basis points. That's about a 9-year high for interest rates in Japan, okay? It was previously at 55 basis points. And that followed on the backs of the Bank of Japan's monetary policy tweak the prior Friday, kind of letting interest rates move up a little bit more freely in a zone that the Bank of Japan has kind of wrapped around their rates, okay? Giving a little bit more flexibility to their yield curve control targets. Meanwhile, the economic information coming out of Japan, it's slowing a little bit in July. The PMI data came in 53.8 from 54 in June. Their manufacturing is in the contraction territory at 49.6. The prior month before that, it was 49.8. And we're seeing that in exports from Japan to Europe and the U.S. and exports from China into the U.S. And Europe. All exports are coming down. Same thing with China, right? You can see China was the only one in the green for the week. Year to date, it's 6.4% in the green. Hang Seng in the red, both year to date and for the week. But China's manufacturing gauge is also below 50. So, we've got to be real careful with these markets. It's kind of a bifurcated market. You got the markets doing its own thing and consumers doing their own thing. Hang on just 1 second, folks. I have got to, let's just get this done here. Hang on 1 minute. Sorry, people, I had to adjust a couple things on my screen here. So that's kind of what we're looking at. All right, just not a very good week. I think it's going to be the beginning of a couple more movements lower. Hang on 1 minute. So let me just switch you over to the charts here real quick. As I'm dying here, choking on my muffin. Let me just swing you over. We're going to go over to the S&P 500 E-mini futures. It'll take about 15 seconds to come up on your screen. And when I'm showing that, you should be able to see it. Okay, you should be able to see the E-mini S&P 500 futures. You can see these little round circles, this yellow and gray and then blue and gray. It projects a potential pullback here on my platform, and it uses a combination of Gann and Fibonacci. Most people don't know how to use Gann, let alone understand it. It can be a little bit complicated, but it's a very good indicator, or a series of support and resistance points, both not only in price level, but timing as well. And you can see here it's projecting a pullback on the higher end side nearby of around 44.75. Now, we closed out this past week at 44.98, so let's call it 4,500. We're in my support zone here, a little bit further out in time through the end of August, a little bit of a further pullback to 43.54. So let's call it 43.50. So you're looking at another 140, 150 points lower as we go out in time. And that really is not a big pullback. If I were to just kind of measure it and just kind of just take it to that midpoint of that level, that puts us right about 6% down. All right. And I said anywhere from 4 to an 8% pullback. And these zones right here show the level of the pullback, meaning short term it can come down, 4%. Going out in time, it can go all the way down to almost a correction territory at 9.54. I don't think it'll get that far down. I think it'll probably find some support initially at the 50 EMA. We may try another little bit of a rally, and then it may roll back over again. But that's kind of what I'm looking at. And then we should have a flourish through the end of the year. But this little pullback here, I'm seeing risk through September into October. Doesn't mean that the risk is we're going to have a catastrophic pullback or even a 4 or 5% pullback. It just means this is a soft period of time for the markets. And this is kind of what I'm seeing right now, all right, on the E-minis. You can see we had an intraday high back on July 27th. We were up 19.81%. And off the highs, we're only down about, almost 3%. So that's not much, right? It's just not much at all. So I do believe we should get a little bit more of a pullback here. If we look at NASDAQ had the worst week of everybody. And you can see here with NASDAQ, now my pullback projection in NASDAQ are a little bit uglier, primarily because rates are moving up. The Feds are going to stay sticky for longer as far as interest rates. Remember, the range right now in the Feds and here in the U.S. markets, it's 5.25% to 5.5%. The markets are projecting the Feds are going to be forced to cut either in Q4 or no later than Q1 of next year, and calling for 2 or 3 rate cuts, getting us back, in the 4.5 to 4.25 range. If the Feds show any tenacity in keeping the rates higher, market's going to have to go through a revaluation, especially tech, and that's going to, pull the tech market, especially NASDAQ 100, which about 7 stocks account for 40% of the index value. And we know the names of those stocks, right? I mean, Apple and Microsoft, Google, Amazon, NVIDIA is one, Tesla, I think they got that out there too. But those are key for us as we look at where interest rates want to go, okay? And of course, if we look at the Dow, it's not as strong as the other stocks, but you could see here with the Dow. Now, if I were to do this calculation on the Dow, I could do a quick little summary here and see what it's saying. And it's saying the Dow can come down 34,770, let's say, down to 34,250, right? And we closed out at 35.1. So, another 800 points, 1,000 points in the Dow, nothing really ugly. But again, you can see the projection zone basically takes us down to the closing price of last year if it starts to get ugly. I don't see any divergences here. And Julie, when you get a higher high here and the MACD doesn't, give us a lower high and a divergence, generally it basically means you want to be a buyer of dips. And that's kind of what all the indexes are telling me right now and what we want to do, right? So if we come down here and look at volatility and we look at the VIX, we had a little bit of a pop on Friday. You can see we were in the upper boundary of the green zone, in the high 13s, low 14s, and we just kind of been sitting here going back and forth. And then we popped right up here. We actually took out the high in the initial VIX pop we had on July the 6th, and we finished towards the highs, okay? And I've been saying if we get this pullback into August, September timeframe, I would not be surprised to see the VIX come up and probably challenge this 2022 area right in this zone right here. The next challenge is going to be right around 20. You can see right over here and over here. So don't be surprised if we get that over the next couple of weeks, all right, with volatility. If we look at the front month skew, comparing the VIX in August, you can see here we're still in a contango, barely, right on the break even here, right? And then when the August vol futures expires, then we move over to the back month, which right now I've got August and September. You can see here we're still in the green. So if we're comparing the August and September volatility futures market, we're still in contango, which is a normalized vol skew. Okay, so let's see if the momentum from Friday's move from the peaks. We moved, I think, intraday over 65 points from the highs on Friday to the lows. And we're only closed down 23 points, but we were up, at one point, 25, 30, 35 points intraday. So let's see where volatility wants to fall in place for us. And then, of course, if we look at treasuries, look at the bond. I haven't even adjusted this one yet. But where the bond market, you can see, hit new 2023 lows, right? And if I were to just kind of adjust this and take us down, that means interest rates are moving higher, right? You can see right here, this is the 2023 low. And when bonds are moving down like this, rates are moving higher. And if we go take a look at interest rates, which is probably what puts some of the downward pressure on the markets, when interest rates get over 4%, it generally pays more and almost zero risk, basically, or risk-free, is to be in a 10-year treasury. 10-year treasury now is, intraday high, it was over 4.2. You can see it came down right here and closed, but still at 4.06. Okay. You can see a little bit of a divergence here, but not much. There was a lot of interest rate movement on Friday. In fact, for the entire week, we've seen the 10-year interest rates moving up and bonds moving lower, right? So we got to watch that very closely. And then, of course, we come into currencies. If we take a look at the US dollar right here, it was down hard on Friday, okay? Now, it's been moving up. This would suggest a little bit of a move lower and then another flush through the end of this downward cycle, because when the markets start to get ugly and start to move lower, generally you have money moving into the US dollar, okay, and the Japanese yen and the Swiss franc, but the dollar especially. And if we look at the euro, you can see the euro over here had a strong finish on Friday, and it's maintaining its 50 EMA. That's a good sign. All right. Now, the Elliott wave count is suggesting we could move lower, but we do not have a divergence from this move here to this move here. So that suggests we're in a buy the dip mode. So this kind of goes in line with what I've been saying for a while here, is we want to play the euro to the long side this year and the dollar to the short side. So you could do that by just playing the euro long, because the euro is about 58% of the dollar index. Okay. And the other one that we want to play long, I've been telling you guys here, is the Japanese yen. So if we look at the yen, well, let's get that on here. As I said, the Japanese government bond is inked up to 65 basis points. And you can see here where we're starting to get that divergence in the MACDs. That does suggest the yen is going to go higher. But when they release their yield curve control, I think it'll just spring up. Right now, it's going to kind of be consolidating in a bottoming formation, but I do like the yen to the upside. And then, of course, we come over here and look at gold. Obviously, gold is in this. Look at the chop and the bounce in gold. I think gold's going to move lower, but then I think longer term we got a shot at it moving higher. I would not trade gold at these levels right here. The last time I had put a trade out for our members was right up at this level here to short gold, and then it came back down again. Right here, it's a no trade in my mind. Okay. If we look at Freeport McMoran with China getting weak, well, so is copper. I mean, if we just step out, look at this regression channel, you can see how it hasn't really moved above the regression channel, but only just recently, and it's having trouble getting above, but it has had no trouble moving below the regression channel. But now we're making a series of higher highs and higher lows. So I want to see that this area holds up. And if it does and we move back up, then we could dip our toe in the water in long copper or Freeport McMoran, because Freeport McMoran follows copper, and that's Foxtrot Charlie X-ray, this ETF right here. And you can see, just like copper, it's hitting these highs right here, and it's kind of resolving itself. All right, there is no divergence here from this high here to this high here, so that does suggest any dip is going to be bought. All right, and of course, if we look at energy, um, it's moving up. It's a little bit, almost just slightly under 83. We're in the green. I think energy is probably going to take out the high price it made for 23 on April the 12th, and move up a little bit higher. Right, that's going to make it harder for inflation to come down lower, because gasoline prices. I also pointed this out, I think, to you guys last week. Check a look at gasoline prices. Right, we've had this move up since early July. Gas has moved up very strong. Now it's pulled back a little bit, but I think it's going to stay higher for longer, which again adds more to the inflation worries. And then of course nat gas, another trade I've been highly encouraging our members. We were selling puts underneath, or doing the way that we trade. We got another way that we can trade nat gas and oil in these commodities. It works out really well. But a real simple one is doing bull put spreads. You know, you're just selling some short strike puts, or shorting some puts below the market, and then buying a long put underneath to hedge your downside if it moves against you. Because nat gas is a very volatile futures contract. So you have to be very careful. But my Elliott wave count is suggesting nat gas, if anything, is going to move up, not down. All right, everybody, that's kind of where we're sitting for this week. If you're not a member, I highly encourage you to come in and check us out. Otherwise, for members, I'll see you this Sunday evening for our weekly market watch at 8 p.m. Eastern Standard Time. Have a great weekend, everybody. Ciao.